Alright everyone, welcome back to Investing Club. In this video, I'm going to talk about Ray Dalio's recent comments about a possible lost decade for the stock market. Now, if you don't know who Ray Dalio is one of the most successful investors in the world. He runs the hedge fund Bridgewater Associates, which is one of the most successful hedge funds in the world. And Ray Dalio has recently come out and said there is an increasing potential for a lost decade for the stock market. So in 10 years, the price of stocks will be exactly the same as they are now. And Ray Dalio brings up some very good points on why he thinks this could happen. So the first thing that Ray Dalio says could lead to a fall in stocks is a reversal of profit margins. Of the US corporate profit margins could lead to the lost decade for equity investors. These margins, which provided a big chunk of the excess returns for equities over cash, would face a shift that go beyond the current cyclical downturn in earnings. So what's the deal with profit margins? In the last 20 to 30 years, we've seen constant growth of profit margins in the US. This is a graph from 1994, and the trend is just consistently going upwards. We've seen profit margins increase to a point where in 1994 they were around 5%, and right now they are over 10%. So these huge margins are part of the reason why stocks have increased so much in the last 15 to 20 years. But there's a couple of reasons why Ray Dalio suspects that profit margins will shrink in the coming decade. The biggest concern that could affect profit margins is the end of globalization, which is probably the largest driver of profitability over the past few decades. And Ray Dalio says this is already peaked. We now have global conflicts such as the US-China trade war and this global pandemic are really accelerating the shift towards domestically produced goods, where countries don't want to rely on other countries to make goods for them. They want to have it in their own country. They want all the production to be done there because that's a lot more reliable than sending it over to another country to have the goods produced, where like we've seen in the last couple of months, at any time a huge global shutdown could happen, and at that point it was hard to get anything produced anywhere. So a lot of countries don't want to go through that again, and they want to start production in their own companies. And we've already seen this with a couple companies in the US. Intel and Taiwan Semiconductor are two companies in the US that have announced that they are going to build their own production facilities in the US despite higher costs. Here's an article talking about Intel and Taiwan Semiconductor are planning to build their own factories in the US to produce their products here instead of overseas where they can do it for less. And so the biggest problem with this is that it's a lot more expensive to produce goods in the US than overseas in somewhere like China, where the wages are lower, the cost of goods are lower. And so this is something that's going to eat into these companies' margins. If this shift continues where we see more and more companies not wanting to depend on other countries for their goods, we would see margins start to decrease as the cost of production goes up. Now, Ray Dalio doesn't mention this, but I think another key reason why profit margins will shrink over the coming decade is because of a change in the corporate tax rate. So right now, the corporate tax rate is at almost a historical low. It's at just over 20%, and it hasn't been this low since 1940. And this corporate tax rate has fluctuated over time. It was as high as over 50% in the 50s and 60s. And so as a result of companies only having to pay half in tax as they did a few decades ago, that's been a huge factor in driving up their margins. Now, will the corporate tax rate stay at 20% forever? Probably not. We just had news break a few days ago that Joe Biden pledged to raise the tax rate to, I think, 28%. Somewhere around there. So that's already a jump. So if Joe Biden becomes elected, he said he would raise the corporate tax rate absolutely 100%. And so that, again, is something that's going to shrink the margins of these companies that are now going to have to start paying more taxes. Now, another thing that Ray Dalio talks about as a big factor for the lost decade in the stock market over the next 10 years is a debt reset, where we've gone to such a peak in debt that it's going to have to reset, and we're going to have to see deleveraging of that debt. And so just to illustrate how much debt US companies have taken on in the past few decades, here's a chart where even though it's been consistently going up, back in 2001, we had around 2.8 trillion in corporate debt, and right now it is at just under 7 trillion. So we've already gone up almost 4 times from just 20 years ago. Now, all this debt is going to come crashing down at some point. Does that mean it's going to be next month or next year? No, it doesn't. It might be a while before it happens. These huge events like this do take time. But I think this will happen in the next decade or so, especially since, as I've said in previous videos, a big reason for all these companies taking on more and more debt is because of the rock bottom interest rates over the past decade. Ever since the great financial crisis, the Federal Reserve has kept rates practically at zero, which basically allows companies to borrow as much money as they want, and they can do it because they're not really paying much interest on it. But interest rates are going to go up eventually, and when they do start to creep up, a lot of companies are going to have trouble paying interest on their debt when they have so much of that debt. And so to illustrate this, here is a chart of the federal funds rate In the 80s, it peaked at around 20%, so that was when interest rates were over 20%, and they've been consistently going down since then, when right now we're at zero and have been for much of the last decade. So I'm going to attempt to overlay this chart here, the total debt compared to the federal funds rate. And as you can see, the lower and lower the interest rate goes, the more debt that companies take on because they're able to afford it, where they don't have to pay as much in interest, so they can afford to keep taking on debt. So this is going to stop eventually, and Ray Dalio thinks it's already started due to the fact that we are in a new depression where we've had the economy shut down for months, and as a result, a lot of these companies are not going to be able to pay their debt that were barely surviving when the economy was open. Now with the shutdown, they're really going to be unable to pay their debt, and as a country, the vast majority of companies in the US are going to have to de-leverage their debt. And this is something that Ray Dalio calls the long-term debt cycle. It's something that happens every 75 to 100 years. So we have both short-term and long-term debt cycles. Historically, we've had a recession around every 5 to 8 years, and that lines up with the short-term debt cycle. When credit starts to tighten up, that's when we see a recession and a slowdown in the economy happen, and that usually coincides with stock market crashes. But there's a longer term debt cycle that's 75 to 100 years that most people aren't aware of, mostly because they weren't around the last time it happened. And the reason that this long-term debt cycle pops is because interest rates are so low they can't go down anymore, where debts are sky high and central banks have juiced the economy as much as they can, which is exactly what we see happening, where rates are already at zero and a recession occurs that cannot be contained. So the rates are already at zero. What's going to happen when there's another slowdown in the economy? They can't go lower than that. At least they're not likely to go negative. And so at that point, we're going to have a period of deleveraging, which is a period where debts are reduced. Ray Dalio argues there's four main ways to reduce debt in the economy. The first one is to cut spending, which a lot of companies and individuals will likely do. There's already been reports that the savings rate among individuals is among the highest it's ever been, and countless companies have stopped share buybacks and cut their dividends, which will help reduce their spending. Another way to reduce debt is simply to write it off, where companies renegotiate their debt so they can pay it off on more favorable terms where they're actually able to, compared to them just defaulting on their debt. And so a lot of lenders don't want a company to default on their debt, so they would be open to restructuring their debt, which a lot of companies will do. Third is wealth redistribution. This is where wealth is redistributed from the top to the bottom, and it's usually done through taxation. And the fourth one is money printing, which we have definitely seen a lot of in the past couple of months, where the Fed has blown up their balance sheet, just printing trillions of more dollars. And so Ray Dalio says this long-term debt cycle is coming to an end. And just for context, the last one was in 1945, and that ended with the Bretton Woods Agreement in 1944, where it was the start of a new global monetary system, right? It took the dollar off the gold standard, and then it fixed all the other currencies to the dollar, which pretty much made America the economic superpower. So back in 1944, 1945, that was just about 75 years ago, so that coincides with the time period that the long-term debt cycle goes through. So Ray Dalio also claims we're going to have a currency crisis where the dollar is going to crash, and we're going to have to see some fundamental systems, and I certainly see the potential for this happening, at least somewhat. I don't think the way that the dollar is going right now is sustainable, and we're going to have some sort of adjustment in the way currency is used and created. And so that can also have an adverse effect on the stock market. Now, you may be thinking, all right, Ray Dalio is saying we're going to have a 10-year period where the stock market goes nowhere, but how can that be? The stock market goes up 8% a year. That's what everyone tells me. If you invest in an index fund, you'll get 7% a year. And while that is true in the long run, throughout history, there have actually been multiple periods, 10 years or longer, where the stock market goes nowhere. It goes sideways for an extended period of time. The first one was in 1929, right before the Great Depression, where you see 1929, the stock market was up here, and we could go all the way to after 1950. So that's a period of 20 years where you wouldn't have made your money back in the stock market. Another one of these times was right here around 1965 all the way to around 1995. That's another period of almost 30 years where if you invested right at the beginning of that time, then you would have been negative until 30 years later. The most recent was the 2000s, starting with the dot-com bubble that ended with the great financial crisis from 2000 to around 2012, 2013, your money would have done absolutely nothing. And so it's definitely not impossible to see another one of these periods where we see the stock market just go sideways for a huge period of time and even have a significant crash in the middle of that. Even though, yes, in the long run, the stock market goes up 7 to 8% a year, historically, it's pretty normal to see periods of consolidation over a longer time period. So what does this mean for the average investor? If I can't even invest in a stock market index and expect to get a good return, what can I do? where interest rates are so low I can't even keep cash in a bank account either. So this isn't financial advice, but here's what I'm doing, and what I think is the best solution is to focus on individual companies that are great businesses, that have great management teams, that have conservative debt levels, and that you know are undervalued. If you focus on that, it doesn't matter if the stock market goes sideways, those stocks you own are going to increase in value eventually. Now, and here's a chart of Berkshire Hathaway, which Warren Buffett is in charge of, and then versus the S&P 500. In the last sideways period we had in the stock market from 2000 to 2012, Berkshire Hathaway actually increased in value. It might not have been much, but we still saw an increase where the stock market was going sideways. And again, that's exactly because what Warren Buffett does, he buys undervalued companies and eventually they return to their fair value. So if you're someone like me who doesn't have super high hopes for the stock market over the next decade, this is what I'm focusing on. I'm focusing on buying select undervalued companies that I'm very confident will go up. So that's it for this video. Ray Dalio definitely has some very interesting points. Let me know what you think. Let me know if you agree with him and you think we're going to see a huge sideways period for the stock market over the next decade, or if you think he doesn't know what he's talking about. And as long as the Federal Reserve just keeps printing money, stocks are just going to keep going up until they stop. A lot of people are on both sides of this argument, so let me know what you think down in the comments. So if you like this video, hit the like button, subscribe to the channel if you haven't already, and I'll see you on the next video.